Okay, let's go.
Driven by greed and hope, many speculators stake an amount on a single trade so disproportionate to their capital that they place their entire financial existence at the mercy of one roll of the dice. This catastrophic error of betting too big destroys more fortunes than panics or market crashes. It stems from the belief that making big money requires taking a massive risk, a logic that often leads to total ruin. Wall Street operates as a relentless, impersonal arena where the laws of mathematics and human psychology prevail. In this environment, risking one's entire capital on a single idea abandons the realm of speculation for pure gambling. Jesse Livermore observed this throughout a career defined by brutal lessons and spectacular triumphs. He eventually based his strategy on a foundation of calculated caution, seeking to navigate the market with professional discipline. While the amateur seeks to get rich quick, the professional aims to get rich surely. This requires a mindset that prioritizes survival above all else, ensuring that no single loss can permanently remove them from the game. Livermore's prime directive was the preservation of capital. He viewed his funds as his business inventory, the ammunition required to stay in the field of battle and act when great opportunities appeared. This chart illustrates the most destructive practice born of an amateur mindset, averaging down. When a trade goes against him, the amateur buys more at lower prices, telling himself he is improving his average. In reality, he is throwing good money after bad to soothe his ego. To average a loss is to willfully defy the market's own verdict. The tape is signaling that the initial judgment was wrong, yet the speculator insists on arguing with reality, a battle that reality always wins. Livermore took the opposite approach through pyramiding. He cut a losing position without a second thought, but showed great confidence in adding to a winning position. This chart shows he only increased his line when the market confirmed his judgment was correct. This method ensures the speculator's largest positions are aligned with the market's primary force. It creates a strategy of offense built upon a foundation of defense, letting the market itself guide capital allocation. This shift from psychology to execution is anchored in cold mathematics, specifically the concept of fixed fractional risk management, the practice of only risking a small, manageable portion of total capital on any single idea. Risking 10% per trade means 5 losses reduce capital by 41%, requiring an enormous gain just to break even. But risking 2% under identical conditions means losing less than 10%. Your resources remain intact, ready for the next opportunity. Conservative position sizing acts as a mathematical necessity. It allows a trader to withstand consecutive losing streaks without having their trading ability significantly impaired. Practically, Livermore implemented this by never entering a full position at once. Instead, he would begin with a small scout position to probe the market. This probe served as a test. If the stock moved in his favor and showed a profit, the tape was confirming his judgment. Only then would he add to his position, buying at higher prices as the move developed. If that initial scout resulted in a loss, he would immediately close the trade. He accepted the small, insignificant loss as a sign that his timing was wrong and the market was not yet ready for the move. To protect against catastrophe, he treated stop losses as a non-negotiable insurance policy. He predetermined the point at which a trade was proven wrong and honored that point without question or hesitation. A mechanical stop loss serves as the antidote to the human tendency to hold on to losers. It takes the decision out of the hands of an emotional human and places it back into the realm of mathematics. This protocol demands that the market prove a trader right before any significant capital is ever placed in harm's way. It ensures the speculator is never heavily invested in a position that isn't already working. By scaling into positions on strength, risking small percentages, and adhering to rigid stops, a speculator builds a fortress around their capital. This approach transforms speculation into a resilient business operation, one that can withstand the inevitable downturns and periods of uncertainty that characterize the markets. Most traders focus so intensely on potential profit that they neglect the certainty of risk. By chasing the one trade they hope will make them rich, they expose themselves to the one loss that makes them poor. Livermore's ultimate rule remains simple. You must manage your risk, or the market will manage it for you. And the market's management style is always ruthless and final. Prioritizing survival ensures that you remain solvent and psychologically sound when the next great trend appears. True fortunes are made by riding those sweeping movements, with a position built carefully upon a foundation of preserved capital.